Welcome back, students of Koi Academy. I am so incredibly excited to have you here for this explainer because today we are going to completely demystify the concept of debt. You know, society loves to paint debt with this massive, broad brush, right? We're constantly told it's either inherently evil and will ruin your life, or it's the ultimate magic secret to getting rich quick. Well, today we are stripping away all that emotion. We're going to look at debt strictly as a mathematical tool for wealth creation, so you can start building your financial future on a rock-solid foundation of facts rather than fear. So, here's our game plan for this explainer. We'll start with the great debt debate, move into the math of leverage, figure out how to categorize good debt, look at exactly when leverage goes wrong, and finally, choosing your path. All right, let's jump into Section 1, the great debt debate, Ramsey versus Cardone. We're kicking things off by looking at two highly successful, massively influential financial experts who have, well, completely opposite views on the subject. On one side, we have Dave Ramsey and his famous debt-free first approach. Ramsey basically believes all debt is a risk that absolutely must be systematically eliminated so you can build a pristine, clean balance sheet before you even think about investing. But then, on the entirely opposite end of the spectrum, we have Grant Cardone's leverage everything strategy. Cardone passionately argues that avoiding debt is actually what keeps you small, and that wealthy people aggressively borrow money to scale up their investments. Now, you've probably heard Ramsey's famous proverb, "The borrower is slave to the lender," and it's totally crucial to understand exactly where he's coming from here. His deeply cautious philosophy wasn't just made up, it was forged in the fire of his own life. He actually went bankrupt in his late 20s because he used leverage that he simply couldn't sustain when the real estate market unexpectedly turned against him. So for him, a clean balance sheet brings absolute peace of mind. It guarantees you are never, ever at the mercy of a bank. But in stark contrast to that, listen to this quote from Cardone. "Debt is not the problem. The wrong kind of debt on the wrong kind of asset is the problem." Cardone is a huge advocate for using OPM, other people's money, like banks, investors, or partners. His whole philosophy is that if you can borrow money to acquire income-generating assets that you could never afford to buy with cash alone, you'd frankly be foolish not to. He literally built a massive real estate empire not by running away from debt, but by harnessing it. Moving right along to Section 2, the math of leverage. Taking all the heated emotion out of the debate, let's just look at the cold, hard numbers. Leverage is simply using borrowed money to control an asset worth way more than you could afford with cash alone. Think of it like a giant financial multiplier. It doesn't inherently care if you win or lose. It simply amplifies your potential upside and your potential downside. And it is entirely dependent on which way the market moves. To see this math in action, let's walk through a classic real estate scenario. Imagine you want to buy a rental property priced at $200,000. Now, instead of dropping $200,000 all in cash, you put down just $40,000, which is 20%, and you borrow the remaining $160,000 from a bank via a mortgage at, let's say, 7%. Think about that. You are now controlling a $200,000 asset using only $40,000 of your own money. Let's look at what happens when things go well. Say that property appreciates in value by just 10% in the first year. It goes from $200,000 up to $220,000. Your gain is $20,000. But remember, you only invested $40,000 of your own cash. That means your $20,000 profit represents a massive 50% return on your actual cash invested. That right there is the incredible wealth-building upside power of leverage. But we have to look at the other side of the blade here. What if the property value drops 10% in that first year, falling down to $180,000? Well, you just lost $20,000. But again, you only put in $40,000 of your own cash. That single 10% market dip just wiped out 50% of your invested capital. Poof, gone. And you still owe the bank their full $160,000. The bank's money amplifies your downside just as aggressively as it amplifies your gains. Which brings us to Section 3, categorizing good debt. Now that you understand the raw mathematical power of leverage, we need a simple, completely foolproof litmus test. And here is the golden rule. Does this asset generate more income than the debt costs? That's it. This singular question is the ultimate framework you must use as a Koi Academy student whenever you are evaluating whether taking on debt is a smart move. If the answer is yes, you're building wealth. If the answer is no, you are just taking on a liability. Let's actually apply this to real estate. A mortgage is only considered good debt if the rental income you collect exceeds your mortgage payment, your taxes, your insurance, and your maintenance costs, resulting in positive cash flow from day one. It absolutely fails if you have negative cash flow and you're just crossing your fingers, hoping the property appreciates in value while you bleed money every single month. What about business debt? Taking out a loan to fund new equipment or a big expansion can absolutely fuel massive growth. But it only works when the revenue from that specific investment clearly and demonstrably exceeds the cost of servicing the debt. It becomes a disastrous trap if you're basing it on wild, speculative optimism rather than validated, proven revenue streams. And yes, even education debt, like student loans, can be categorized as good debt under the right conditions. It works beautifully if the degree directly leads to a massive income jump that easily justifies the cost, keeping your total debt below your expected first-year salary. But it fails miserably if you rack up $120,000 in loans for a field that tops out at a $42,000 salary. The credentials simply must have a clear return on investment. Okay, Section 4. When leverage goes wrong. Listen, we cannot discuss the wealth-building upside of borrowing without addressing exactly how it can utterly destroy your wealth. Relying on negative cash flow and calling it an appreciation play? That's just speculation with borrowed money. Over-leveraging leaves you with zero cushion if, say, a tenant suddenly stops paying. Getting squeezed by variable rate debt in a rising interest rate environment? That can double your monthly payments literally overnight. Stacking loans on a shaky financial foundation when you don't even have an emergency fund is a guaranteed recipe for collapse. And honestly, this is exactly why Dave Ramsey is so profoundly cautious. Finally, Section 5, choosing your financial path. We've looked at the philosophy, we've crunched the math, we laid out the rules, and we explored the risks. Now you have to objectively assess your own life. You need to look in the mirror and ask yourself, which philosophy actually fits my financial situation today? You really have to evaluate your own personal risk tolerance and the stability of your current income before deciding to wield the awesome power of leverage. Let's break this down. The Ramsey approach fits perfectly if you currently have consumer debt, if you lack a fully funded emergency fund, or if your income is pretty unstable. You absolutely must clear and solidify your foundation first. But if you already have a rock-solid foundation, you fully understand the math we covered today, and you've identified a cash-flowing asset, then Cardone's strategic leverage approach can dramatically accelerate your path to wealth. But here is the grand takeaway, the one thing both of these titans of finance completely agree on. Despite their massive, glaring disagreements on leverage, both Ramsey and Cardone completely agree that using debt to buy things that depreciate in value, like taking out a personal loan to fund a vacation or buy a new wardrobe, is always a terrible, wealth-destroying idea. Good debt funds assets that generate income, bad debt funds consumption that generates absolutely nothing. So as you continue moving forward in your financial journey here at Koi Academy, I want to leave you with this one critical question. Are you preparing to use debt to fund your future assets, or are you just borrowing to fund your present consumption? I really want you to think deeply about that the next time you're tempted to take on a new liability. Master the math, build your foundation, and I will see you in the next explainer.